Certainly a lot of optimism. S&P 500 up 23% year to date, a new record high this week. So clearly the markets are in good mood. I think there's a number of reasons. Number one, clearly the big macro story is the US-China trade negotiations, a partial deal being signed. That diminishes the risk of any escalation in tariffs going forward. But importantly, some speculation today that we might have some reversal of the tariffs already implemented. That would certainly be very good news. Secondly, the US economic data has begun to stabilize. So we've had GDP data, which was a little bit better than expected. We had the jobs report last week, which was stronger than expected. And the ISM manufacturing index picked up a little bit. So some better news from the US. Third, the no-deal Brexit risk has clearly diminished quite a lot. Whatever happens in terms of the general election, I think the prospects of no-deal Brexit are now very, very small. And I think finally, and very importantly, we shouldn't forget we've had a lot of central bank monetary easing this year. Not just from the major G10 central banks, the Fed, RBA, RBNZ, ECB, but also the BRICS, the four key emerging market economies, and a cumulative 560 basis points of monetary easing year to date. So a lot of support from central banks that is helping to lift current investor sentiment. Well, I mentioned there the US economic data has stabilized, but, within the details of some of the data, it's still suggesting downside risks to growth going forward. So, for example, the payrolls report, yes, the actual job increase was a bit better than expected, but we still have a deceleration in employment growth. And also on top of that, the hourly earnings decelerated and the hours worked has slowed. So overall national income is likely to decelerate, and that means consumer spending is likely to slow in the fourth quarter. The GDP data for the third quarter, there was no growth outside of consumer spending. So the Fed is really dependent on the consumer keeping the US economy going, and there are some question marks over whether that will continue. So some downside risks we feel in terms of the US economy. And then on China, we still believe that the whole uncertainty about trade, yes, it's a negative for the Chinese economy, but there is an underlying weakness in terms of the debt levels in China, and therefore Chinese growth is going to continue to decelerate going forward. And when you have the two engines of global growth, China and the US decelerating, that makes for clear uncertainty in terms of global growth going forward. I think if I'm to point at good news, it's here in Europe. And when I go back to the US-China trade negotiations, there is now speculation that the US will not implement the auto tariffs, a decision that needs to be made in the coming days and weeks. And that is important for Europe, obviously, given Germany is the largest auto exporter in the world. If that risk is pushed back or eliminated, that's very, very positive for Europe. The Euro Stoxx automobile index is up 17% in the last 20 days. That's the largest gain in that period in 4 years. Secondly, this week we had data from the Centix. The Centix index jumped by 12.25 percentage points. That's the largest increase since 2009. It's still negative, but it does correlate very tightly with the IFO Business Climate Index, and it suggests that we're about to get a turnaround in manufacturing sentiment, which in turn suggests that maybe the technical recession in Germany is coming to an end and we're about to get some rebound in manufacturing activity. So when we look at the relative macro divergence between the US and Europe, we could be in a situation next year where we have the best relative story for Europe since 2017. And that to me tells us that we could see some further gains for euro dollar, and we could see a soft trend to the upside for euro dollar in 2020.